Welcome to our YouTube video on the impact of the Union Budget's angel tax provisions on Indian startups. This year's Union Budget has made news with the widening of the scope of angel tax to money raised from non-resident investors. The concept of angel tax was initially introduced by the government in 2012 to tax unaccounted money finding its way back into the system through share issuances at unusual premiums. A subject of continuing discussion, this provision has been used lately by the income tax authorities to raise demands on startups raising capital at valuations unheard of in traditional business models so far. Previously, capital raised from non-resident investors and from domestic AIFs or VC funds used to be exempt from the angel tax. However, removal of the exemption for non-residents while retaining it for domestic AIFs has now created an unequal playing field for funds which are domiciled offshore, such as in Singapore or Mauritius. As these provisions are specifically exempted for recognized startups not having completed 10 years from incorporation and meeting specified criteria, such as aggregate share capital and premium not exceeding 25 crore and turnover not exceeding 100 crore, only a select number of smaller new startups can benefit from existing thresholds. With the increase in global liquidity squeeze leading to the onset of the funding winter for Indian startups, raising capital for startups has become quite challenging. Amidst such times, an onerous tax provision such as angel tax is likely to further dent the ability of Indian startups to raise capital at good valuations. While the FEMA regulations permit an Indian company to raise capital from foreign investors at or above the fair market value of the shares, with this change in the Union Budget, non-resident investors may be expected to negotiate further on valuations and indemnities in order to factor the risk of an angel tax-related litigation on valuations and returns. The tax department has in fact litigated on fair market values where the actual future performance has been at a deviation from that projected at the time of the fundraise. In the backdrop of this situation, the startups look to the government to actively consider certain incentives in order to ease their burden. Exempting funds raised from SEBI-registered foreign portfolio investors or from foreign VC funds managed by licensed fund managers will help bring in fair competition between domestic and foreign investors on capital-raising transactions. The government should also consider exempting funds raised from companies listed on overseas stock exchanges to even out the playing field. Furthermore, the government may consider providing for tolerance limits to enable raising funds from foreign investors at higher than fair market values, as permitted by the FEMA regulations. Lastly, raising the turnover and capital-related exemption thresholds for PIT-recognized startups will also provide a shot in the arm for some of these businesses where access to capital is vital for long-term sustainability. Only time can tell whether any of these expectations will be duly considered by the government, but some of the above relaxations will surely go a long way in helping Indian businesses raise growth capital in tough times such as these. We hope you have gathered the necessary information with this video. Thank you for watching.